Which takes us to our talk of the tape, which is where are the opportunities with stocks at such lofty levels? Joining me here at Post 9 to discuss VantageRock's Avery Sheffield. Avery, thanks for joining us today.
Pleasure.
So you think that both the economy and inflation are likely to run warm to hot?
Yes.
So does that suggest you think stocks can also go higher from here despite kind of these loftier valuations we're seeing?
I think they certainly could, but I do think it creates a more opportunity for a more bifurcated market where those stocks that benefit from pricing power that aren't over-levered can really shine, especially if the valuations are still low, and those that might be in a situation where rates might not be able to come down enough to help them, could have a little bit more trouble. But overall, I think that the environment's supportive because the Fed really wants the economy to do well and has a lot of opportunity to cut rates should anything be wobbly.
So the goal then is to find those pockets that are maybe undervalued but likely to outpace inflation because of their ability to raise prices on consumers or raise prices on the businesses that they sell to?
Yes, raise prices and also have the cost pressures potentially from tariffs, cost pressures from their own inflation and labor already priced into the stocks.
So are there specific sectors that you believe kind of fit that mold in particular?
Yes. So two sectors that I think are pretty interesting here still are auto-levered stocks, as well as some stocks in consumer discretionary retail. So in autos in particular, there was a lot of concern that tariffs would have a very significant negative impact on the OEMs and the entire industry this year. Actually, from conference commentaries recently, in the past couple weeks, the OEMs are managing through this much better than anticipated. Demand has still remained strong, despite concerns over the high price of autos. Used car values are holding in. And so I think that given the demand picture looks okay here, if on balance the Fed's likely to lower rates, not raise rates, that creates a nice demand backdrop. And then from a cost standpoint, I think the cost pressures are already in, and if anything, likely to get better as the OEMs figure out how to navigate even further through tariffs than they already have. And so you would have a benefit from OEMs that are strategically well-placed with products that customers really like, with maybe floundering competition. I can't mention specific names, but there are opportunities trading at over 10% free cash flow yields. And then in the auto dealers as well, they should benefit from a strong market, from having 40% of their volumes in parts and service, or revenues, which continues to be quite strong, still very low valuations. And then you have on the consumer discretionary side, you have multiple retailers now that are kind of in a turnaround with relatively newer CEOs. You have it in apparel retail, you have it even in jewelry retail, again, trading at very low valuations. The tariff concerns are really in their current guidance. And so I think there's really just opportunity to the upside should the economy hold up.
Yeah, all of that being priced in. Avery, hang tight 1 second.